I welcome CA Tarun Chaurasia sir and our coordinator Ashima Kalra ma'am in our webinar. I requested to Ashima Kalra ma'am, please give introduction of our speaker, today's speaker, CA Tarun Chaurasia sir, and give him a welcome note.
Thank you so much, sir, for setting up the stage for today's webinar and for your continuous guidance. So, good afternoon, everyone. My name is Ashima Kalra, and I am pleased to introduce and welcome our esteemed faculty for today's session, Mr. Tarun Chaurasia. Mr. Chaurasia is a well-known name in the private equity and venture capital industry, and his insightful tagline, "Fundraising is an extreme sport, be cautious," aptly reflects the theme of our discussion today. With over 20 years of experience in finance and investments, he has spent more than a decade as a CFO and Vice President of Investments at a prominent private equity fund. His expertise will provide invaluable insights into the workings of the fund and the process of raising equity capital in today's session. Throughout his career, he has been an active speaker at numerous conferences, seminars, and training sessions related to private equity and venture capital. He has held influential roles in respected multinational organizations, including BHW Home Finance, Fidelity Fund Management, and Citibank. Notably, he served in a strategic leadership position at Rabobank Private Equity Fund for over a decade. Additionally, he serves as a regular faculty member for ICAI certificate course on valuation and fundraising and has authored numerous articles on topics such as entrepreneurship, fundraising, and valuation. We are fortunate to have him today with us, and I look forward to his valuable insights. Over to you, sir.
Thank you. Thank you, Ashima. Can you please confirm that if my voice is audible and my picture is visible to all of you? Is everything
Yes,
is in order?
I can see you and I can hear you very well.
Yes,
Well,
sir.
thank you very
PPT
much.
and your voice is audible. Both are visible and audible.
Excellent. So technology is working, which is good. So good afternoon, everyone, and thank you very much for taking out time on this Friday afternoon. Uh, I All right. So, without taking much of your time, I'm actually using a phone to, to speak. And at the same time, I'm using a laptop to run the presentation. So I might be looking at my laptop while I'm talking on phone. There is some problem in my laptop camera, which I just realized 10 minutes back. So pardon if I'm looking at the other screen and not at you. So today's discussion, I wanted to be more practical, as Ashima spoke that I worked for over 10 years with a well-known private equity fund, and I've seen the in and out working of how a typical venture capital or a private equity fund operates. How do you evaluate investments? What are the challenges? So, being as I understand that, you're all qualified chartered accountants with reasonable amount of experience. So I'm not going to talk about anything which is theoretical or boring in nature, for which you will have tons and tons of literature and article available all over the internet. I would rather share my personal experience and the problems which I face on a day in day out basis, because I've been neck deep in evaluating various investment opportunities, including for startups and MSME as well, right? So let's move forward. I have prepared this presentation. Let's go one by one. And I would request that please keep asking questions in the middle of the presentation, so that I should not be feeling that I'm speaking to the screen. There should be, active discussion on this particular webinar. All right. So I have divided the presentation in two parts. One is the investor's perspective, and second is the founder's journey, right? Well, being a founder, being a business owner who is looking to raise capital, and you acting as an advisor to those founders and business owners, it is extremely important for each one of us to understand, how these venture capital and private equity fund operates. So once you understand the inside process, the nuances of their working, you will be in a better position to advise and also to work on your fundraising journey. So I've divided this presentation in two parts. Part one, we're going to strictly going to talk about how this fund actually operates. What's the process? How do they evaluate the investment opportunity? And in part two, we're going to talk about putting ourselves in the capacity of a founder or a business owner who is looking to raise capital, right? Like step one, step two, and step three. So we'll try to cover as much ground as possible. So here we go. So let's start with part one, which is the investor's journey. Right. So, step number one, what happened typically, either you acting as an advisor to a founder or a founder himself, you somehow you are able to generate the contact detail of prospective investors from multiple sources. The first step that happens is that you send out a pitch deck to a prospective investor or a message or a teaser or something else in a hope and expectation that they will look into your the documents that you have shared with them. So typically it is the analyst at the fund level who receives that particular pitch deck, right? So that's step number one. That analyst within the fund, he receives your document and he start looking into it. Okay. The first thing that any analyst or any other person whosoever is receiving your deck will do is to check, does this business, does this pitch deck, does it connect with the investment thesis of my fund or not? This is the first thing. Now, not connecting or not matching with the investment thesis, this is the first and the most important. This is the most. This is one of the reason where most of the proposals get rejected. Right. Let me give you an example that I worked for Rabobank Private Equity Fund, which was a sector-focused fund. Right. We were primarily working on the food and agriculture market in India. So my mandate, my constitution, my investment thesis, whichever way you wish to define it, was to make investment in India, primarily in this particular sector, with a ticket size of, let's say, about a minimum of $5 million, and it goes up to $15 million. So broadly, it defines my investment thesis in terms of the sector, in terms of the ticket size, and in terms of the geography, right? So this is the key outline for us to start evaluating the investment opportunity. Now we used to receive a lot of proposals from lot of promoters. They have been sending the pitch decks from different industries, different sectors. Somebody is looking to raise $50 million. Somebody is looking to raise just $1 million, and you are going to straight away reject those proposals simply because it does not match with your investment thesis. It doesn't matter how good the proposal is, how interesting, how profitable, and what kind of a future this particular business would hold. It doesn't matter. Simply because of the fact that my constitution, which lay down the principle of investment thesis, does not allow it, I'm going to reject it. And this is one of the reasons that most of the proposals received by the funds gets rejected. Now, this brings us to a very important question that as an advisor or as a founder, it is extremely, extremely critical for you to read through the investment thesis of the fund. It's not like that you get a list of the investors somewhere from Google and you start circulating your messages or pitch deck. It doesn't work that way. You got to spend time on each of these investors, understand their investment thesis, and once you realize that yes, my business and their investment thesis connect, then you should go ahead and drop that pitch deck. Otherwise, it's absolutely a complete waste of time. Let's move on. Next step, which is spotting the opportunity. Let's assume that the analyst who received the pitch deck, he looked into it, he spent, let's say, 1-2 minutes just to check whether it meets my investment thesis or not. Assume it met the investment thesis of the fund. The next thing the analyst is going to do is to check, is it really a good opportunity or not? Right now, there are no predefined rules or set of procedures which one would follow. But the whole idea is to basically look at the pitch deck and check, is it worth spending time? Is it worth evaluating the investment opportunity or not? Right. That's where the first quick review of the pitch deck which they have received, take place. So that's the step. Now, once the analyst kind of did a first-hand review of the pitch deck, what he will do is he's obviously going to invite the founder or the business owner to get into a quick call, because he might be having a lot of questions. There are a lot of information gap in the pitch deck. So he's going to call the promoters or the founders to have a quick discussion on the business. And the whole idea to have this discussion is to get a better understanding of the business and its dynamics, right? So usually the first call happened. The promoters are supposed to run through the pitch deck to the investors, and the analyst would have questions basis the requirement and the information gap which is there in the pitch deck, and this casual exchange of information happen. So that's the first communication between the investor and the promoter of the company. That's what happened, right? Well, assume that the analyst is happy, and it's time for him to get into the detail. He start researching about competitors, he start analyzing your data, the information. The whole objective is to start getting deeper into the business opportunity. The whole objective is to kind of the whole objective is to kind of build confidence on the business opportunity, and he might in between ask for more information and more document depending upon the requirement. Next step is the second meeting. Now what happened, this is the time when the analyst speak to his senior, who is typically a fund manager. Fund manager is usually of a partner level. He apprised the fund manager that, look, this is the deal that I have received, and this looks a good business opportunity. And I have already have one level of discussion with the founders. I like the founders. The sector is good, and the investment theses are well intact. And I would kind of encourage you and request you to let's move forward. So that's kind of an filtration completed by the analyst, and he's requesting his immediate senior, who is a fund manager, to kind of let's have a second call with the promoter and discuss the deal in detail. Now this time the fund manager and the analyst, they jointly hold a discussion with the promoter or the founders. And again, the call might run into 30 minutes to 60 minutes, and fund manager would have questions which is more visionary in nature, more strategic in nature with respect to the business plan, the market size, and the big picture. So that's the second meeting. Now, founders already have two meetings, one-on-one with the analyst, and second with the founder and second with the fund manager and the analyst. Now it's time for the fund to start working internally, right? Now the analyst is fine with the deal, the fund manager is fine with the deal, the next step in the process of evaluation of investment is basically the deal team huddle. Now, there is not just one fund manager or one analyst in the team. You might be having 4 5 fund manager. They are all working on different deals. There might be 4 5 analysts as well. So it might be a total team size of, let's say, 8 9 10, whatever it is, right? So what happened that now every analyst, every fund manager concurrently working and dealing with different set of promoters, right? And each of them are in the process of evaluating the investment opportunity. Now, let's say there are 4 fund managers and let's say 4 analysts, right? One set of team. Now, deal team is fund manager and the analyst that together form a deal team, right? So one deal team would be directly or indirectly interacting with maybe one founder or 2 founder or 3 founder. And similarly, the other deal team are concurrently working with the rest of the businesses as well. So everybody brings the deal to the table, and a joint discussion happen between between the all the investment professional, like all the fund managers, all the analysts. They come together and they start discussing the deal. Now each deal team present their respective proposal, and they take feedback from the entire team. If there is something which any other fund manager or any other analyst like to kind of share some feedback or information with respect to the deal, they would come forward and share the information. So it's like a uh, it's like a bigger team meeting where all the investment professionals, including the managing partner of the fund, would do the discussion and arrive at a consensus. Sorry, just let me just switch on the. All right. Let's move on to the next step. The deal team. Sorry, the investment team, which consists of multiple deal team. We have had a discussion, and it's time for the deal team to prepare an investment note. Now, what is investment note? Investment note is nothing but very much similar to a pitch deck, which you have received from the founder, right? Similarly, it's time for the deal team to prepare a pitch deck and submit it to the investment committee for approval, right? Now, this is a very, very detailed investment note, and it is prepared from a strategic perspective, practically covering every important and meaningful information with respect to the business. It talks about the business, it talks about the number, it talks about the valuation expectation, it gives you the calculation of the valuation, it gives you the financial model numbers, the business plan, the product and service, everything, right? So typically, we used to prepare this investment note running into like 20, uh, 15 to 20 pages and submit it to the investment committee for review. Now, investment committee is typically consist of highly experienced, investment professionals. It includes the members of GP. Sometimes it also include the representative of the limited partners, and sometimes it also include independent third party experts on the subject. So it is usually, you can say, it's a team of 4 to 5 set of people who's going to receive this investment note and discuss it, right? Now it's time for the investment committee to take a decision whether it's a good proposal or a bad proposal. It might reject it, and if they reject it, over and out. If they approve it, it's time for the deal team to move on to the next step, right? At times, what happened that investment committee kind of requests for more information and more documents. In such a scenario, the deal team goes back to the promoter, collate all that information, come back to the investment committee for another set of discussion, And then finally, the IC, the investment committee, takes a decision whether it's a good proposal or a bad proposal. So that's how it happened. Okay, let's assume that the investment committee discussed the matter in detail, and it's time for the investor to sign the term sheet, which is already being prepared. It's already been kind of agreed between the investor and the founder, and both the parties sign the term sheet, and that's the step number one. That's the first formal step in the relationship between the investor and the founder. Term sheet is nothing but a summary of the terms and conditions of the investment. It captures the brief outlines, which becomes the basis for the investors to make an investment. What next? Now, the analyst and the fund manager, they previously collated a lot of information and documents from the founders. They read that information, they reviewed that information, and basis that reading and review, they prepared the investment note and submitted to the investment committee, and the investment committee approved it, right? So far, the fund had been relying on what has been submitted by the founder to them. Now it's time to do a cross check whether the information submitted by the founder, is it correct or not. So due diligence comes into the picture. Now due diligence is a process wherein the fund appoint a third party vendor, third party vendor to conduct due diligence. So they might, let's say, appoint somebody to do the accounting and tax diligence, somebody else to do the legal and secretarial diligence, somebody else to do the environmental diligence, somebody else to do the forensic diligence, somebody else to do the business diligence, maybe another third party to go out and do the market survey, right? So different vendors, different professional firms are being appointed to do the due diligence of the business. And, it is not necessary that all diligence are carried out. It completely depends upon the proposal. If it is, take for an example, if it is a forensic due diligence, which typically happens in more bigger transaction and mature businesses where the background of the promoters or the founder is not very clear. So you might like to find one of the forensic firms to do the diligence, and so on and so forth. uh, in very early stage of proposals, most of these funds have an in-house diligence team, right? So they will have a separate team of diligence, and instead of appointing a third party vendor, they might like to do it themselves. It saves time, it saves cost, and because the number of these that they work on is quite large in today's time. So take for an example of a fund which is doing a deals of just a $500,000 or maybe a little less than that, right? And they have a target that in 1 month of time frame, they would do about 4 to 5 deals. Now, in scenario like this, it is little impractical to go out and appoint third party vendors. So they have their own due diligence team which conducts the diligence. Okay, next step, the DD reports. Now, once the due diligence auditors are appointed, the next step is these auditors, these professional firms will submit the DD reports to the fund. Now, important point here to note is that these DD reports are private and confidential in nature, and the promoter or the founder would not have access to it, right? The professional third party vendor would directly submit it to the fund for review with absolutely no access to the founder. With regard to the cost of due diligence, it depends. Sometimes it is 100% redirected to the founder to bear the cost of the diligence. Sometimes it is 50-50, and sometimes in some cases it is the fund which takes the cost. So it depends. It's a part of the negotiation that who will bear the cost. Sometimes a condition is attached that if you end up making an investment, then the founder say, oh, it's completely okay. We are happy with the diligence cost, whatever it may be. But if the investment did not follow, then we would not bear this particular cost. So it's a purely a negotiation game, and also depends upon the kind of deal that the investor is evaluating. A lot of factors comes into the picture when it comes to the cost of due diligence. A review of DD reports. So the due diligence report from all the professional firms are received by the investor. It's time for the deal team to be back in action. They start examining clause by clause, line by line. They read the reports submitted. They cross check with their internal diligence. And the objective here is to find, is there any red flag here? Is there any material inconsistency with respect to the information and the knowledge that we already have? Is there anything in the diligence report which might help or which might force the investment committee to change its decision? So what deal team does, they prepared a summary of all the findings of the diligence report. It's like a 1 or 2 pager. They send it back to the investment committee that look, the DD has completed. We have kind of summarized the diligence report, and here are the red flags, right? And this is the impact of that red flags on the deal. Or maybe there are no red flags, everything is in order, so on and so forth, right? So it's time for the investment committee to kind of take, let me move on to the next slide, the final IC approval. So the IC receives the summary of the diligence report, and there might be red flags and there may not be red flags. Now, depending upon the findings, IC might tweak and approve the investment with certain changes, or it might say, go ahead, absolutely everything is fine, there are no red flags, let's move on as we agreed in the term sheet. Or the IC will say, no, 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 this is something we were not told. Maybe there is some heavy litigation that was the finding of the legal due diligence auditor, which come to the notice of the deal team and the investment committee, and the IC might request for an indemnity or some kind. Maybe they put some kind of terms and conditions. So due diligence is an extremely important step in the process of evaluating an investment opportunity for any investor. If you have done your DD well, there are high chances that your investment might not collapse, although it's not a guarantee. Well, legal framework. It's time that IC's final approval has been received, and it's time for the fund lawyers and the promoters' lawyers to come together and settle down and agreed on a legal documentation, which essentially involves preparation of shareholders and share subscription agreement. A detailed negotiation happens clause by clause. The investors team, the promoters team, they both sit together, and once they agreed on the documentation, both the parties sign it, and this is the moment when the deal is technically and legally, binding on both the parties. Now, the agreements has been signed, and the fund is under an obligation to uh, do the funding to the company. Now, what happened? It's time for the fund to call for capital, okay, from their investors, their LPs, in certain ratio which has already been agreed. Now, when a fund is prepared, you would have seen in news article that some ABCD fund is launched. It's a $250 million fund having ABCD LPs on board. Now, the $250 million is not something which LPs has already paid and it is there in the bank account of the fund. No, it's not the case. When you read that $250 million fund is launched, and let's say there are 10 different investors, maybe in equal proportion, it we call it as a commitment on the part of the limited partners towards the fund, right? So maybe investor A would have committed 10 million, investor B would have committed 30 million, and so on and so forth. So they're committed that whenever you will call for capital, we are under an obligation to provide you the money, right? So let's say that there are 10 LPs, the call for capital goes, and all of these 10 different investors, they contribute in the agreed ratio. The money comes to the fund, and once the money is received, then it is being funded to the company. So typically, a capital call notice is being circulated by the fund to their LPs with a 15 days notice, and the investor takes their own time. They remit the money to the fund bank account once the money is received from all the LPs, and the next is to remit the money to the fund. All right, we already covered this point number 17, that once you receive the money from all the LPs, it's time to transfer the fund from the fund bank account to the company's bank account. This is the last point in terms of the process of how the investment opportunities are evaluated by the fund. Uh, Once the fund is being transferred from the investor's bank account to the company's bank account, the company is under an obligation to immediately conduct a board meeting and allot the shares. This is this is uh, uh, technically the last step wherein we can say the investment process has completed. Usually, it happens on the same day when the fund is being received by the company from the investors. So everything is planned, the board papers are ready, the share certificates are ready. And if you look at the practical side of it, that everybody is sitting in one room and they've been constantly coordinating with their bankers. Is the fund received? Is the fund received or not? And the moment the fund hits to their bank account, they immediately conduct the board meeting, allot the share certificate, and the deal is done. Okay. So it's extremely important for each one of us to this is the sorry. Okay, this is the next part. The whole objective of making you understand that how typically a private equity fund or a venture capital fund operate, because if you don't know the process, you won't be able to do justice with your fundraising journey, both as an advisor and also as a promoter yourself, right? So it's a detailed, well thought through, well organized, and a structured process which every fund follow. There may be certain funds, or the smaller size funds, who have been doing deals primarily and only in the startup phase. छोटी छोटी deal वो लोग कर रहे हैं, and they might skip one or two steps, right? For example, instead of two investment committee meetings, they might just hold one investment committee meetings. Similarly, instead of appointing a third party due diligence auditor, they might be having in-house due diligence team. Similarly, instead of appointing a lawyer from outside, they might be having an internal legal team with a standard set agreement where you have to sign it, right? So depending upon the size of funds, depending upon uh, uh, the ticket size of the deal, depending upon the importance, significance of the deal, this process that I've spoken about, it might go little up and little up down, but broadly, the entire process is well structured and well organized. That's what we all need to know about it. So I'll take a break here, and I would request each one of you to please let's discuss and ask questions that you might be having. because I don't want this to be one-way journey. Over to you. Please ask any clarifications and the question that you might be having. Patrick, पानी की बोतल।
Sir, is there any Tarun sir, your voice is not audible.
Yeah, can you hear me?
Yes, sir. Yes, sir.
I've just taken a break so that people can ask questions
Yeah,
before we move on.
I have shared.
Where
I have
have you
shared the
shared?
question with you on WhatsApp.
Okay, you shared it on WhatsApp. 1 second. All right, I've got a few questions. Let me answer it one by one. Question number one is, what is the most common source of equity funds in a typical small businesses? Well, the most common source of raising equity fund is the venture capital funds, and there are various category of investors, and I have a separate slide onto it. We'll talk a little bit more in detail, but it's the ecosystem of the venture capital and the private equity world which provides equity funding, right? They might come in the form of an HNI, they might come in the form of an angel network, they might come in the form of an incubator or an accelerator or a family office. There are different category of investors in the market, but they are all part and parcel of the larger picture of the venture capital industry that we are talking about. Okay, so this is where you usually raise the equity funds. Well, question number two: why is fundraising important for a startup? Well, point number one is that finance, money, cash is the blood of business. If you don't have cash, you may not be able to grow, or you may be able to grow, but not at the same speed and pace which ideally you could have if you have a lot of money. Okay, that's point number one. So it's a question of your growth, your business plan, your ambition, and how fast you want it to grow. That's point number one. Point number two, uh, is it, you know, you ask a question that why it is important. No, it's not important. I mean, there is no need to raise fund. If you're happy with the growth, if you're happy with the profitability, you're happy with the business, it's completely okay. There is no necessity, there is no mandate that you got to go out and raise capital. But if you intend to grow faster in your business, then yes, equity is the perhaps one of the important milestone in your business line. What is the main purpose of fundraising? The main purpose of fundraising is basically to bring finance to your business plan, and that's the reason where that you raise fund. Instead of raising debt, you go ahead and take equity funding, and there is another slide that I've prepared here, that why you should be focusing on debt funding rather than equity funding. So completely it's your choice here. What are the primary reasons that startups need funding? I think I've already answered this question, that to finance your growth, you might be having a fantastic idea. You have already incorporated a company, you already have a team of people, you have a business plan, but you don't have money, right? So in order to grow and expand and give a shape to your business plan, you've got to get some cash. You get this cash either through debt or through equity. At times that is difficult because you might be in a very, very early stage of your business and equity comes handy here. So you go out and knock the doors of several investors, equity investors, so that you can raise funding. How do startups spend their funding? Well, when you raise equity funding, you got to submit a well-structured business plan that this is my plan, this is how I'm going to spend my money. I'm going to buy some machinery. I'm going to, set up few offices. I would need this much of money for working capital, and I would need this much of money for a capex. I would need this much of money for branding and marketing and so on and so forth, right? It's already been discussed, captured, and also incorporated in the legal agreement that we are giving you XYZ amount of money, and you have asked this money for the following purposes. So it gives a detailed breakup. You would have seen that it's quite common in the pitch deck, that fund utilization slide. So typically, you say that, okay, we are looking to raise $2 million, and then where you're going to utilize it. So you said, okay, I will utilize $250,000 in let's say launching another market in a different state, another $500,000 to start the export market, $250,000 for the working capital, $100,000 to set up another office, and so on and so forth. So it's already been discussed, agreed, and written in the shareholder agreement. And as a startup, as a business owner, you are under an obligation to follow that business plan. And if you're deviating from that utilization of the money or deviating from the business plan, you are definitely violating the terms and conditions of the shareholders agreement. So it's important to go back to the investors and share with them the changes. If you propose any, get this agreed in writing before you move forward. Are the company's employees unionized? Sorry, I do not understand this question well. You might need to help me to understand this question. Companies employ unionized. What's that mean? I mean, never heard this before. But I'll move on to question number 7 until I get the clarification from this question. How to evaluate equity value with company value? How to evaluate equity value with company value in startups? Okay. See, let's take an example that you're looking to raise $5 million from a prospective investors, and the question is that if the investor gives you $5 million, how much equity share capital that they will get in return? Is it 5%? Is it 10%? Is it 15%? Is it 20% or more? Okay. So what you do the valuation of the company. Okay. Now, again, valuation is another subject. You apply methods, you take external help, and so many other things that you do. And both the parties agree on the valuation of the company, right? Let's say, the investors say, I place $50 million as the value of your company before investment, and I am going to invest $5 million. Okay. So essentially, you are going to get 10% of the equity against and $5 million of equity funding, right? So that's your equity value, and $50 million is your company value. Is investment thesis public? Yes, it is public. Again, I have another slide exclusively or addressing this particular question. We will discuss this little later. Where to find fund contact details? Again, I have another slide in part 2 of this session. You will have answer to this question. So let's wait and park this particular question. Please discuss valuation methodology. Well, there are this particular session is not on valuation, because valuation in itself is a very, very vast subject. It requires several hours to understand, but largely, there are DCF, there are comparable methods, there are venture capital method, and there are several methods of valuations which comes into the picture. Which method to choose depends on a lot of factors. All right. So we finished part one, wherein we discussed the investment process typically followed by the fund while evaluating the investment opportunity. We discussed about the role of analyst, how it all started. We discussed about the role of fund manager, how it started, all the way from analyst to fund manager, from fund manager to the entire team discussion, from there to investment committee discussion, from there to diligence, from diligence to back to the investment committee, from investment committee to sealing the legal agreement, and from agreements to capital call notice, from capital call notice to funding, and finally the allotment of shares. That's the process usually followed by almost all private equity funds. Now let's talk about and understand the journey of a founder, or if you're an advisor, then you need to know how it moves step by step. Understanding the different stages of a business life cycle is critical. Now we all know that uh, you know business run through different stages. We keep on receiving so many pitch decks with just an idea, but they have a glamorous pitch deck. There might be proposals which is at an MVP stage. There might be a proposal where the product has been launched, or it might be at a prototype stage, or it has started working. It's in a very, very early stage of uh, business, but it is yet to start generating revenue, or it might have started generating revenue, or it might be having a mature business, but yet to be EBITDA positive, or it might be having reached to a stage where it's EBITDA positive. So there are different stages of the business, and we all understand it's not a rocket science to understand that which stage you are at in terms of your business. Now, the important question here is that why it is important, because there are different category of investors in the market. I spoke about it a little earlier. So you have so many angel networks. Okay, you have too many incubators. Excuse me. You have too many incubators, accelerators, family offices, venture capital funds, private equity funds, DFIs, and whatnot. Now, each of these category of investors has a specific way and style of working. Typically, they have a fixed, typically, I would call it that different investor category would have different types of investment thesis. Let's take an example, right? Let's take an example, an angel network. There are so many angel network, right? Indian angel network, Mumbai angel network, Chennai angel network, Chandigarh angel network, right? कम से कम 40 30 40 एंजल नेटवर्क्स तो होंगे आज की डेट में. Now, behind one angel network, there are so many, HNI individuals. It's like it's nothing but a but a set of people who have come together and formed that angel network with an intent to make an investment. Now, such kind of investor community, they are okay to back those promoters who are at idea stage, or maybe MVP stage, product launch stage, etc., etc. But there may be certain category of investors, such as early stage VC funds, right? If you reach out to them with an idea state or a product launch state and so on and so forth, they would typically not entertain you at all. Now, why it is important that you should be able to connect कि मेरा बिजनेस किस कैटेगरी ऑफ इन्वेस्टर्स को मुझे अप्रोच करना चाहिए, राइट? Would an angel network would be the ideal set of prospective investor for me? Would angel networks would typically consider my proposal, or maybe I have crossed that stage, you know? No, I need to approach a VC fund because they might be able to understand this kind of a business better. Oh, maybe I have crossed the VC stage. I need to approach a private equity fund. So understand your category, understand the category of the investors, and connect it well, right? That's the whole purpose. All of these points are relevant for you and I to understand why you have so high rejection rate. You would see promoters and founders in the market, they're saying, oh, I've sent 20 emails, I've sent 50 messages, nobody is responding. And if people have responded, they have only rejected my deal, right? No, fundraising journey is a very, very strategic process. It's not like circulating a marketing document to anybody and everybody. You got to understand the various nitty gritties of how to raise capital. Let's move on to the next slide. Should you raise funds now or hit pause? There are a few pointers here. Understanding the transaction and the scale of the business, the high risk of early stage funding, the cost of equity funding, and investors want to see scalability. Now, it looks like almost anybody and everybody who is doing a startup, they are all hunting in the market for a prospective investors. They're all thinking that some angel, some investor will come someday and will put money into my business, and that's how I will grow. Instead of focusing on their business, instead of focusing on their business model, they are just wandering left and right all over the place in search of the investors, right? It's extremely important to uh, understand the timing of your fundraising journey. Let me give you an example, right? Even I received so many proposal which is at a very, very early stage. Like, you just had an idea and you might have, joined hands with one of your co-founder. You might have just incorporated a company, you might have secured a PAN number, and you will receive a amazing pitch deck with lot of information into it, information about market opportunity, information about competitors, information about industry, information about this is what we wanted to do, a, a nicely prepared financial projection for the next 5 years. Absolutely every content of the pitch deck is futuristic. On the ground, when you speak to these business owners and the founders, there is just nothing. Have you launched the product? No. Have you tested the product? No. What stage have you started generating revenue? No. Why would somebody would invest into your business at an idea stage, or maybe in a stage which is a little better than an idea stage? Let's be very, very honest. Okay. There are very, very few investors in the market who would be willing to take a bet on you just because of an idea, unless and until you have an history, maybe history of building big businesses, or you might be, let's take an example that you might be the founder of Paytm, and you have an excellent idea, and you decided to bring that idea into execution. Well, since he is a Paytm founder, I am sure there are 10 set of different institutional investors who would line up to give money to this particular guy. But if you and I will stand up probably the chances that you get funded is very, very negligible. So please, please go back to the drawing board and check, can I hold, can I run my business for another 6 months or maybe in another year or maybe a little more than that, and then go to the market and raise fund? Is this the right time or not? Very, very critical and the most important question. And this is one of the important reason for rejection, right? People says कि मेरे को कोई फंड नहीं कर रहा है, मैंने इतने इन्वेस्टर्स को अप्रोच किया, nobody is responding, nobody is saying yes to me. So it's all the problem lies with the business, frankly speaking, right? Why you should not be raising high amount of fund in an early stage of funding? Simply because, let's take an example that you're a small business and you end up raising money more than what you need. You might be needing just $500,000 or maybe $1 million. But when you're going ahead in the market and making your pitch, you're saying, I'm looking to raise $2 million. No need for it. The moment you get $2 million, you're going to have tremendous amount of pressure to use that $2 million as quickly as possible, because at the end of the day, you have to get back to your investors for the returns that you're going to make and give it back to your investor community, right? So take only that much of money, which is optimum and which is good for the business. It should not happen that you get, okay, aane do, paisa hai to aane do. The higher the money, the better it is. That's absolutely not the good strategy. Uh, Cost of equity funding. Well, the cost of equity funding is very, very high. It's a fundamental, basic finance question whether debt is cheaper or equity is cheaper. Hmm. Well, it's the debt which is cheaper, and equity is very, very expensive, because equity takes the ownership from you. You might have to part away 10% or 15% or 20% of your ownership to a prospective investor, right? Versus a debt funding where you only have to pay the interest, and that is also deductible under the tax law, right? That's a very, very, very dynamic situation here. Should we raise equity? Should we raise debt? I have another slide for it. We'll discuss more a little bit in detail in the following slide. Another important point here is in terms of the timing of your fundraise is that almost every investor practically wants to see scalability into your business. They wanted to see, boss, on the ground कुछ काम किया है या नहीं किया है, right? Exceptions are always there for every damn thing, right? There are investors who might back you at a very, very, very early stage. It could be an idea stage or something similar to that. But majority of the investors wanted to see the scale in your business, right? It should not happen कि आपने 10 लाख रुपए की सेल करी है और आप बोल रहे हैं मेरे को 15 करोड़ रुपए रेज करने हैं. It doesn't work there. The moment you start putting yourself in the investor's shoe, you will get the answer for this, right? So please think about it. Is it the right time or not? Because if it is not the right time, you're bound to get rejection after rejection, and then you're going to demoralize yourself, thinking that your product, your business model, your services are not good and it's not working out. Sorry, I'll take a water break. All right, we move on to the next slide. All right, we We missed this. You got to wait for the right moment. That's important here. Great ideas are cool, but it's the execution that seals the deal. Like, we just covered it, but maybe we can quickly discuss this. Uh, we briefly talk about it that if you ask me, in today's time, ideas have zero value. I'm sorry to highlight this, but that's what it is. Each one of us have multiple ideas keep coming. यार ये कर लेते हैं, वो कर लेते हैं, यहाँ पे टेक बना लेते हैं, ये रिटेल का बिजनेस कर लेते हैं. It's all in our head. Does it matter? Yeah, it matters, or it may not matter. Frankly speaking, it might matter to you, but it may not matter to a prospective investor. Nobody is willing to fund an idea. Again, exceptions are always there. It's not the case that investors previously have not funded the idea. They have funded the ideas, but it's like one out of let's say 1,000 in deal in today's time. Everybody is keen at your execution capability. That are you able to business plan? Are you scale or not? It brings a confidence to the investor community. It shows the proof of capability. It helps the investors to mitigate their risk, and obviously it brings clarification that you're solving some problem. Okay, why listening to market and industry experts is the key to your success. It's the, I would call it, is extremely important. I mean, in my personal experience, uh, I would say, have you ever met with a founder who says that my idea, my business model is not good, or he's not confident about it? You will never hear that. The mere fact that he's doing a business is evidence of the fact that he believes in his idea, he believes in his business model, and he believes that his business will grow. Right? Every founder will say this. If you look at their financial position, it's like a hockey stick, starting from 10 lakh of revenue and reaching to, let's say, 100 and 200 crores of revenue. That's the story of every single pitch deck that you will come across in the market. Still, how many businesses get funded by the investor community? 95% still get rejection on every single day. How many businesses actually succeed? How many businesses are actually failed? I don't have to explain this. It's all factual. Everybody know that startups have a great amount of failure rate, right? Now the question is, हमको लगता है सब कुछ बढ़िया है, ये बिजनेस बहुत बढ़िया है, ये आइडिया बहुत बढ़िया है, मॉडल बहुत बढ़िया है, हम इसको कर लेंगे, बट आपके लगने से क्या होता है? So one of the good and strategic point here is that you should always discuss whatever is in your mind to some senior industry experts. They could be your friends, they could be your relatives, some office colleagues, somebody somewhere. कि बॉस, यार मैं ये बिजनेस शुरू करने की सोच रहा हूँ, या मैंने ये बिजनेस शुरू किया है, right? What do you think about it, right? Do you think that it is scalable? Do you think that it will work in the market? If not, just a generic discussion. Take the feedback. understand the mindset of that particular person. क्या बोल रहा है वो, it's important for you to know the know the realities on the ground, right? Honestly speaking, multiple times I have ideas that came to my mind, and such fantastic ideas which I believe it's a good idea, and that idea remains in my head for like many months, and I've been just thinking, will it work or not? Is it good or not? Because executing an idea takes a hell amount of resources in terms of time and money. पता लगा आपने बिल्ड करना शुरू कर दिया, आपने लोग हायर कर लिए, पैसा लगा दिया, सब कुछ कर लिया, and ultimately you realize it's not working out, you know. So instead of getting feedback at a later stage, you should try and get that feedback now. Discuss your business proposition, take feedback, be rational, don't be emotional in your business world. Emotions doesn't work in the world of business. Besides the idea, the third party expert with tons of experience, he might help you in structuring your fundraising approach. He might help you with respect to the timing of your fundraising efforts. बॉस अभी मत करो, यू आर टू अर्ली, थोड़ा 6 महीने रुक जाओ, या आपको अभी पैसा नहीं मिलेगा मार्केट, डोंट वेस्ट योर टाइम, सो some experts advice is always needed. Similarly, the expert might come back and give you some feedback कि यार आप ऐसा करो, इसको ऐसे लॉन्च मत करो, या इस मार्केट में लॉन्च मत करो, and so on and so forth. I mean, with so many businesses that I've evaluated in the last 15 years, I mean, when I receive the pitch deck, it's like, yaar, bekar hai, ye chalega nahi, You just come out with that thought whether will it work or not. I can be completely wrong. That third party industry professional or an expert can be completely wrong. I'm not saying they're 100% right, but their experience has a weight, and it's important for each one of us to understand them and to gain their feedback. That's the point which I'm trying to make here. Let's move on to the. Sorry, मैं थोड़ा बोलते बोलते थक गया हूँ. Give me 1 minute of break, and then I'll resume.
Sir, you are on mute, sir.
No, I am not on mute. I was just taking a 1 minute of break because I'm feeling a little
Okay,
tired.
okay.
I've been
No
speaking for
problem, no
last.
problem. You can, sir. After 15 minutes, we can do
No,
discuss.
We'll
No, no,
continue.
I'm no, sir. I'm saying after 15 minutes, around 3:30, we can discuss another few questions.
Yeah, absolutely. At 3:30, we'll stop. I'm expecting that at that point in time, we will be able to complete our session. So we'll
Yeah,
leave it to the floor to ask questions.
yeah, sure, no problem, sir.
All right. So coming back to the next slide, why not that? I think we are all qualified chartered accountants. We all understand the fundamentals and the basic difference between debt and equity. But I always believe that if your business has the potential to raise debt, you must raise debt. Equity funding over a period of time has become quite glamorous. It's kind of have perceived as a sign of success, that it's like an approval from a uh, uh, external world that your business, your product, and your services are working. But the fact is that how how many how many businesses have practically grown who have been funded. It's like if 1,000 businesses have been funded, have all of them have succeeded? The answer is no, not all of them have succeeded. That brings us to a basic question, that equity funding to your business is not a guarantee of success to your business, right? Investors can also completely go wrong. Founder can also completely go wrong, right? If you're growing, I would advise you to take debt. A debt could be from friends, partner, relative, family member, etc., etc. But if your business is in a position to secure a debt from a financial institution, take that, build the business to a level that you are in a position to actually go out and secure equity funding. Don't be in a rush. There's no glamour here. The moment the moment you receive an equity funding, it's like a time bomb which is ticking and it can explode at any point in time. Right? So uh, objective of the business should not be to raise equity funding. The objective should be to build a solid business plan. That's the important point here. All right. The next slide is why a solid plan is your secret weapon for fundraising success. Now, you see, these equity investors are long-term investors. They are typically here to invest in your business for a minimum of next 5 to 6 years. It could be 7 years. It could be 8 years. It could also be 4 years. You might grow very fast, and the investor might choose to take an exit in the fourth year of business. Quite possible. But here the point is that all of these equity investors are long-term investors. They're looking for a big picture. In a situation like this, they're always looking for a solid business plan. Everybody asks, what's your business plan? Okay, business plan essentially consists of a big market size, a market opportunity. Can your business be scaled fast? Is it scalable? Right? How the financial projections looks like? What's your growth strategy? You might be having direct or indirect competitors. How you're going to outperform your competitors, and what are the risks that we are going to take, and what are the risk mitigants, right? So a solid business plan can play a very, very important role in convincing a prospective investors about a prospective investment opportunity. All right, the next slide is finding the sweet spot. It's a very common problem among the founders that I think we briefly discussed about it, but let's let's discuss a little bit more in detail, that how much cash that we should raise. I have numerous practical examples where founders are approaching to the investors asking for a very high amount of capital, and it's and I've personally given feedback to a lot of founders कि आपको इतना पैसा नहीं मिलेगा market में, right? And I take that assessment basis the stage of your business, what you have built up so far, right? So you might come across a picture that you're looking to raise $2 million, and the investors think that no, this guy is not for 2 million, and we cannot fund more than $500,000, and they might put some conditions, milestones, performance yardsticks, where they will say, okay, you take 500,000 now, and that's the best we can do. But if you are doing well, we might come back with you with another $500,000, and so on and so forth, right? So please uh, discuss this important point, kitna cash chahiye, right? We talk about the risk of taking too much of capital and the risk of taking too little capital. You really have to be balancing between the two sets of figures. If you raise too low amount, you might be run out of cash very soon, and you might be going back to the market in the very next few months asking for more capital, which is not advisable, right? So you should be asking for an optimum amount of capital, which is not too high and too low. How do you get answer to this question? Should we get $500,000? Should we get $2 million? What, right? The answer lies in the financial model. Now I have a separate slide on the financial model, and we'll discuss about it, that how financial models are prepared and why it is important to prepare a financial model, and how do you get this answer of how much cash that you should raise, and how do you get that answer from the financial model. Well, this is a very common question, and there are too much of literature written uh, all over the internet, that how should we prepare a pitch deck? What is it that we should cover it, right? Is there any set of rules and principles that we need to follow? What is it that investors like, and so on and so forth, right? It's a very common struggle among the founders. Let me give you a different perspective to it, right? Point number one, there are no set rules and principles or a list that, okay, this is what you need to cover, this is what you should not be covering, this should be the number of slide, so on and so forth. Let's understand the background to it, right? You are approaching an investors, and you are looking forward to raise certain amount of capital. You got to be into the shoe of an investor and start thinking like an investor, that if somebody approaches you with this particular deck, is it sufficient enough for me to take a call and to take a decision or not? That's the simple answer to a very big question in terms of what you should be covering. That's point number one. Point number two is, I would suggest that always keep it very simple and contain meaningful information. That's the whole secret of success for preparing a good pitch deck. Think like an investor and keep it simple and yet meaningful, right? Every investor wanted to know, there are three stages. There are three parts to who you are. So your past, your present, and your future. All three things are important, right? So first you need to tell your past. Okay, this is who I am, this is what my company is, this is what I have already achieved. Product has been launched, product has gone to the market, these are the numbers, and so on and so forth. What is the present of your business proposition? This is where we are today. And the third point is, the third part of your deck is, this is where we wanted to go. Now, investor needs to build some confidence by looking at your past, by looking at your present, right? That's called the evidence and the proof that you are somewhere into the business. It's not just fancy deck with projections and rosy future pictures. It should not be the case, right? Second point that I'm going to keep it simple. You don't need to be glamorous. You don't need to, put unnecessary gyan about the industry, the market, and those standard slides. We are putting 20 competitors and slides, take, and so on and so forth. No, no, no. Build meaningful information. which is relevant and important for the investor to know. Try to build data, try to build facts, try to build information, right? मेरे ये 10 प्रोडक्ट हैं, हर एक प्रोडक्ट का स्टेटस क्या है, कितने प्रोडक्ट बिक चुके हैं, अब मैं क्या करने वाला हूँ. थिंक फ्रॉम द पर्सपेक्टिव दैट जिस इन्वेस्टर्स को आप अप्रोच कर रहे हो, वो ऐसे पिच डेक डेली उसके पास 10 आते हैं, right? And it doesn't take much time for that particular investors to take a decision कि ये चलेगा कि नहीं चलेगा, is it worth evaluating or not, and so on and so forth, right? So he receives such proposals day in day out. He's quite smart, he's more experienced in evaluating proposals. So you got to keep all this thing in mind and build your pitch deck accordingly. Give a brief overview about your business, little bit about your industry. They are my competitors. This is what I'm looking to raise. This is how I'm going to use my this is how I'm going to use my funds, and so on and so forth. Right? So there are there's a big list of the content that you might cover, and you can easily get it from Google. It's all over the internet. The important point is that while you cover that information, the information should be relevant and meaningful, which help the investors to take a decision. That's the point here. Why teaser is your startup's secret weapon for catching investor attention? Now, teaser is nothing but a summary 2 to 3 page document of a bigger document, which is pitch deck. Now, why teaser is important? Because it's short, simple, and easy. Every investor is busy. No matter how much research that you do about a particular investor, you will still end up knocking the wrong door, right? And there is no point of sending 20-page document to a prospective investors. Send them 2-pager or 3-pager smart document which consists of meaningful information. अगर उस इन्वेस्टर को थोड़ा सा भी इंटरेस्ट होगा, directly or indirectly, the investor will definitely come back to you, right? If you send a 20-page document, he will get lost. So build a simple teaser. Like when I build a teaser, I simply use a Word file with just 2 columns, multiple rows. I start with name of the company, promoter this, industry this, subsector this, what is the business, this is the business, this is the problem, this is the solution, this is my financial, this is my shareholding structure, this is the brief about my team. No, just build that relevant information. तो जैसे ही खोलेगा इन्वेस्टर के सामने, वो एक पेज आएगा और एक पेज में वो सब कुछ पढ़ लेगा कंपनी के बारे में, राइट? Don't try to hide the information. You are what you are, right? Hiding will not solve the problem. So it's always advisable to circulate a teaser. And once you gain interest from any of the prospective investors, then send a pitch deck, right? But keep in mind, the teaser should not be incomplete. Okay, if it is incomplete, you're unnecessarily bothering an investor and he might just drop it in the trash. It definitely help a prospective investors to gain his attention. Got to respect the investors' time, because all these investors are busy in evaluating multiple opportunities at the same time. They've been receiving these pitch decks from different sources. So multiple founders are sending, the investment bankers, the advisors, and all sorts of proposals, good proposals, bad proposals, very bad proposals, very good proposals. Everybody is directing to his table, and he has to quickly filter it, stage 1, stage 2, and stage 3, which we initially discussed in part 1 of the session. It creates a curiosity in the mind, and obviously it helps that analyst to quickly filter it. That's an important point. Financial modeling. Okay, guys, just give me 1 minute break. I'll quickly go to the loo and come back here. Okay, all right. Sorry for the interruption, and I'm back here. Now, what is financial modeling? Financial modeling is much way and beyond just preparing the balance sheet and the profit and loss account for the next 5 years. Uh, uh, I would call it that it's a job of an expert to build a good financial model. And as I said, and I'm repeating it again because it's an important point, it is beyond the preparation of just the balance sheet and the profit and loss account for the next 5 years, right? You need a top class Excel modeling skills because you got to build in, so many business assumptions. Every single sheet would link to each other in such a fashion, in such a manner that if you change just the assumption, the entire the entire scenario of profitability or cash will change. It needs to be prepared in that manner, in that fashion. And trust me, I am saying with a lot of experience that if you have not prepared a financial model before, you got to really learn it. There are courses in the market which talks about how to prepare a financial model, and you must do it. It doesn't matter whether you are a CEO or not. Uh, Financial modeling is also an important tool, and it help you to build your valuation, right? Especially the DCF. And it also help the prospective investors to build a scenario analysis, right? So you change in one sheet, the multiple assumptions are there, and you keep doing the hit and trial game. It's like playing a game. Okay, it's like that. You are thinking that you will launch the product in the June month of next year. So that's your assumptions, right? Now let's say that you want to check what if my product is not launched in the June of next year. Instead, it launch uh, maybe a bit early or maybe a little late. How the entire finances will change. Have you been able to build your financial model to that level that every single assumption that you have built into the business that can directly or indirectly impact your business and your finances, is it all there or not? That's the point which I'm trying to make. So as a promoter, as a founder, you should build a scenario analysis, and investor will definitely do a scenario analysis to check what if it goes down, and if it goes down, what if it goes further down, right? So there are best case scenario, there are worst case scenario, there are good case, there are bad case, and so on and so forth. Well, valuation is always tricky, and it's a never-ending tussle between any founder or an investors. The founder is always looking for more and more, and I want to call it that investor is in a serious is struggling to bring it down to you, but it's a tussle, and the answer lies in data. Unfortunately, that it's like one out of 100 founders brings the data on the table. Now, bringing data is the job of an expert. 99% of the founders, 99% of the advisors, and that's a problem I'm talking about. Problem with the advisors, which is we chartered accountants, and problem with the founders. They just build a financial model and they do a DCF. Now, DCF is a mathematical calculation, right? Once you have a financial model in place, you apply a certain weighted average cost of capital, you incorporate certain assumptions. There are templates which are easily available all over the internet. You download those templates, you fill in the information on the basis of your financial model, you click it, and you have a valuation. I'm sorry to say, but the valuation game is much beyond the calculation of DCF. You got to do your valuation work from many perspectives, and but you got to use multiple method. Which method to use, where to use, when to use. It's very specific to the deal in hand, very specific to the business, very specific to the industry. There is no set of rules and principle which I can share and guide you that this is how you should do. The whole idea is to apply multiple valuation method, gather a lot of information from the market, build a base and submit it to your prospective investor if you want a good valuation. Mere a DCF calculation would not work at all, simply because DCF is based on the future projection. Like we are moving from 1 crore to 200 crores of top line, 10 lakhs of profit to 10 crores of EBITDA. It's not going to work because that financial projection is just a rosy picture. It's a dream. You're thinking that it will be achieved. So investors do not give too much of emphasis to DCF in majority of the cases, especially in case of startups. Right? So you got to find a right balance in terms of the expectation, and do not get rigid. I would say that be reasonable, do the calculation, collate data, take the help of an external expert, and that's where you will be able to nail the game of valuation for your business. I think we have left with few slides, so let's complete those slides and then we will jump onto the question answer. Understanding the category of investors in your fundraising. I think we briefly talked about it, that why it is important for you to understand various category of investors. So I've written on my slide, there are incubators, there are accelerators, HNIs, angel networks, venture debt funds, family offices, there are strategic investors, there are crowdfunding platforms, there are pension funds, there are development financial institutions, there are sovereign welfare funds, there are fund of funds, there are VC funds, there are PE funds, there are impact funds, there are government funds, there are government schemes, so and so, right? Capital availability of capital is not an issue in the market. There's too many investors and too much of capital. Absolutely, I can give you in writing the number and the number of investors and the category of investors what we have today in 2024 versus we had 5 year or 6 year or 8 year back is like many fold, right? So you have all kinds of investors to take care of all category of businesses. problem is that when you talk to an investor, they said quality deals are missing, right? The good businesses, the scalable businesses are missing. That's the feedback that we get from while we talk to multiple category of investors, right? Every investor, every single investors received, let's say, 10 proposals in a day. Out of 10 proposals, they usually reject upfront level. Right? The rejection rate is very high. We briefly discussed about the reasons of rejections, and and one of the reason is highlighted right here on your screen, that you got to understand that which category of investor that I should be targeting. For example, you might be sending your proposal to a fund of fund. Now, fund of fund is a different category of fund who makes an investment into the fund. You know, so you might be approaching a completely wrong set of investors and wasting your time and securing rejection after rejection. So please understand the dynamics and nature of these category of investors and move accordingly. Well, million dollar questions: how to research an investor's investment thesis and why understanding the investment thesis is critical. If you're not reading the investment thesis, whether you're an advisor or you're a founder, I'm telling you, this is the biggest mistake that you are doing as a professional and the founder is doing as a business owner. You know, it's like shooting an arrow and you don't have a goal. It's like launching a product in the market and you haven't really surveyed your market. You know, it's a stupidity. It's complete immaturity that if you do not understand and if you do not read the investment thesis. How do you read the investment thesis? Source number one: go to their website. You must and you will get a lot of material which gives you a direction that what category of investment that this particular fund will make. Point number two: browse their LinkedIn profile, read their profile. It will have some information. Point number three: the news articles. Whenever a fund is launched, you know, the first close and the final close, in 99% of the cases, it comes in the news. And the news will be like, okay, if Sequoia has launched $250 million fund or is in the process of launching, you know, the $250 million fund, and as per the managing partner of the fund, you know, they are looking to make investment in such and such sectors. There will be an interview of that particular partner. So you get the crux कि ये fund जो है जब लॉन्च हुआ था वो इस इन्वेस्टमेंट थीसिस के फोकस करके जो है लॉन्च हुआ था. Fourth, study past investment. Not a big deal. Just Google it, put the name of the investor. You will get who all have secured investment from this category of investment, right? And fifth, there are subscription to databases available. These databases may not give you the investment thesis in detail, but they give you the the list of those companies and the list of those investments where this particular investor has made investment, right? Let me tell you, I have given you 5 important points, and leaving the point number 5 aside, you should and you must read all the 4 points. Go to the website, go to the LinkedIn profile, read the news, and study the past investment. When you read all those 4 different sources, that fills you with the relevant and correct amount of information कि क्या ये इन्वेस्टर मेरे लिए सही है, क्या ये मेरे बिजनेस में इन्वेस्ट करेगा. You are able to evaluate and make an assessment with respect to the sector, industry, business, size, ticket size, and whatnot. Unfortunately, It's a time consuming task. If you start reviewing an investor, it takes anywhere between 10 to 15 minutes of time to read that one investors. But the problem is nobody, and the thing to do, secure an email, attach your pitch deck, send it. And then you're thinking why people are not responding to my emails. You've got to really look into it. This is the most important slide and feedback that I'm giving it to you in your fundraising journey. Another important question, how to get connected with a prospective investor. पहुंचे कैसे वहां तक? ये तो पता है मार्केट में इन्वेस्टर्स है. We know that abundant amount of capital is available. But how do we reach out? I don't know anybody. That's a basic fundamental question. Now again, it's a journey. It's a process. No, it doesn't happen overnight. So let's talk about few things. Strategic nature of networking. Start networking with your colleagues, with your friend circles, and especially with those founders who have received some amount of funding from some investors. They will guide you. How did they start it? How did they reach out to that particular investor? So that feedback will be, that networking will be important. Leveraging LinkedIn for networking. You got to really reach out to that. पहले आपने research कर लिया, investment thesis पढ़ लिया, you have reached to that conclusion and to that decision that this ABCD investor is good. ये मेरे लिए सही है और मुझे इसको pitch deck भेजना चाहिए. Once you have done that, you don't have to connect with all the investors. No, you don't have to do that. There might be 1,000. Let's say I have a list of about 3,000 different names. I'm not talking about individuals. I'm talking about institutions. 3,000 names. Are they all relevant for me? The answer is no. But are you supposed to review those 3,000 names? Yes. कैसे पता लगेगा कि कौन सा इन्वेस्टर कहाँ इन्वेस्ट करता है, right? So you got to review, you got to read it, and once you finalize your target investor, reach out to them on LinkedIn, send them a simple two-liner message. Don't send a pitch deck, don't send a lengthy message. Dear sir, I have read your investment thesis and I'm keen to share my pitch deck. Could you please share your email ID? Avoid asking for a contact number, they don't give generally. But email ID, they don't mind it. Once you get an email, so you're already connected. You have already built your base over LinkedIn. And when you send an email to that investor, the investor knows that, okay, this guy got connected through me email and I had given my email to this guy. So that's where you build the connection. Build relationship. We just talked about it, that sending a small two-liner message requesting for is nothing but building a relationship. Don't ever send cold emails. It doesn't work. Nobody likes cold email. Even you receive cold emails in your personal and professional email ID every single day, and we have that tendency to ignore it. We all ignore it. Avoid that. Fundraising is not about collating email IDs and sending it to everybody and let's see kya hoga. It's not that way. Attend conferences. There are too many conferences, networking events happen. Go out there, exchange cards, meet more people, and get feedback. How do you approach? And so on. Obviously, it's not an overnight job. It takes time. Referrals. Role of investment banker. It's extremely important. You should definitely approach an investment banker, who has a built-in database and who know exactly who to approach and whom not to approach, right? So I'm an investment banker. I keep working on multiple days on a daily day-to-day basis. I have a database. I have an Excel sheet. I know exactly कि ये इन्वेस्टर ये डील करेगा कि नहीं करेगा, right? That level of research, that level of foundation, these investment bankers have already built in. You don't have to do all that effort, right? They already have the contact details of the investor. They already know personally and professionally to that particular investor. So you don't have to do the hard work. You should live, coordinate, do as in if you're a practicing chartered accountant, you might jump onto a strategic relationship with some investment banker who might directly or indirectly work with you on that particular deal. And then there are other platforms reached out to angel networks. There are syndicates, incubators, accelerators, online platform. All in all, it's a journey. It's not, it's not an, it's not something that you're going to do in a few days. Have patience. It might take 6 months, 8 months. I know people who have been struggling and hunting in the market for months and months, and finally they kind of drop the idea of raising funds. So have patience. Identifying a right investor who can invest into your business is a very, very big deal. Oh, excellent. We have completed, I have completed my slides, and I would request that you please ask questions. We can take up the questions and discuss your queries and clarifications before we complete the session. Devang, are you there?
Yes, sir. I have shared the questions with you on WhatsApp.
Have you shared another list or is it the same?
Another list of questions, sir.
All right. Got it. Got it. Got it. Got it. I got your questions. Okay. Let me take one by one. So question is, what financial and operational metrics do investors prioritize when evaluating equity investment? Well, you're talking about the which information the investors prioritize. Now it's a very generic question. There is nothing like prioritize. Okay. When you're making an investment, you're not making an investment of few hundred and a few thousand rupees, right? You're talking about big investment and it's a long-term game that we're talking about. It's important that any founder and any business owner should typically satisfy a particular investor from all perspective, right? The investor, the market size is important for the investors. The problem is important for the investors. The solution is important for the important. The strength of the team is important for the investors, right? Can this business is this business scalable or not is important for an investors. Can this business provide exponential growth is important for the investors. Is there any technology which is involved in your business is important for the investors. So I wouldn't say that this particular thing is important or that particular thing is more important. No, I think nobody likes to make an investment if they're not satisfied with the overall investment opportunity. So that's the answer to the question. Let me move on to question number 2. Please discuss various terms in the term sheet. Well, the various terms is like, okay, this is the amount of investment that I'm giving you one by one. Point number 1, that, okay, we agree to make an investment into your business of XYZ amount. We will disburse these amount in multiple tranches. Uh, this is the financial instrument that we will use. We might be making equity investment. We might be investing in a CCPS, compulsory cumulative convertible preference share, or maybe notes. There are milestones which needs to be satisfied before you can ask for a second tranche. These are the list of rights that we will secure from you. For example, there are called reserve rights. Reserve rights means that any strategic decision or any strategic matter, we needs a prior approval of the investors. So all those rights, all those terms, all those conditions, that how diligence will be conducted, who will pay for the due diligence cost, and uh, so on and so forth. So, almost it is, term sheet is nothing, as I said earlier. It's like a summary document of the bigger document, which is the shareholders and shareholder subscription agreement. It's like, just like you have a teaser in comparison to a pitch deck, similarly, you have a term sheet in comparison to a shareholder agreement, which capture, it's a memorandum of understanding between two sets of people, right? That's the whole point here. Next question: what are the best practices for pitching to investors, and how can startup MSMEs stand out? Well, the best practices is, we talked about it, but if I have to summarize few pointers: build a nice, smart teaser containing a meaningful information. Number two, read the investment thesis. If you're not reading the investment thesis, then you're doing the biggest mistake in your fundraising journey. Point number three, that build connection with a prospective investor to whom you want to send out a teaser. These three are most important point. And another one is that, is it the right time? Is it the right stage of my business to go out and hunt for equity funding? And concurrently, if you can secure some feedback from the market, it's good. Discuss how much money the startup has to raise in phases. Well, there is no answer to it. How much money depends upon the business, the deal, the dynamics. You might be looking for $100,000. Your business might require $10 million. Every case is different, every deal is different, every business is different. The important point here, which I've made in the one of the previous slide, is you should not be raising too low amount, and you should not be raising too much. That's, your raising amount should be optimum, right? And what is that optimum raising amount? The answer lies in the financial model and also the market conditions. Next question, you did not mention about technical technology though. Yes, very good point. I have missed it. Technical and technology diligence in today's time is extremely important. If your business is directly or indirectly involved in any technical part of it, uh, the a third party technical expert and or technology expert will be appointed to conduct that diligence. It is very, very important. How do we get the list of investors or HNIs? Well, if you Google it, you will get so many links where you get so many names of the investors. You will have to do a really, really long research. There is no one platform which can give you a list except the paid platforms. So there are paid platforms, for example, Crunchbase. They typically take about 30 to 40,000 rupees a year, and you get the database of all the investors. You get ki, okay, investor A has made in so many companies, made investment in so many companies, and so forth. So if you're ready to pay, you can get the data more structured, more organized versus your Google search. Next question, and the last question: startup early stage funding will be done by investors or only after starting generating revenue? Well, we covered it, but let me reiterate it. Uh, in majority of the cases that, I mean, first of all, there is no set rule or principle that if you're not generating revenue, you will not get funding, or if you're generating revenue, only then you will get funding. If your product, there is no answer to it, right? Different category of investors, different types of investors have a different level of appetite, because each of these investors have a different level of investment thesis. There are investors in the market who is hunting for businesses or hunting for promoters who has a good idea and a good team, and they're happy to give you $200,000 or just $300,000, or maybe a quarter of the $1 million. There are investors who are saying, no, don't come to us if your business has not started generating revenue. It depends upon the investment thesis of the investor. The answer lies in the investment thesis. Okay. It lies on the appetite of the investor. The answer lies on the risk-taking ability of the investor. And all of this information lies in the investment thesis, and the investment thesis can be the information about the investment thesis can be secure, as we discussed in one of the previous slides, through website, LinkedIn profile, Google News, and so on and so forth. So that's all from my side. If there are no further questions, then we can move on. And I'm happy to answer any other question that you might be having.
No, sir, there is no any such last. This is the last question. There is no any more questions from the members. So I requested Ashima Kalra ma'am, please give the vote of thanks to our speaker, Tarun Chaurasia sir, and then we close the session.
Thank you so much, sir, for your valuable insight into the industry. And I really understand, and I'm quite sure that now how startups generally struggle to raise funds in their initial years. But today, with your session, this deep session today, I think a lot of us would get immense help to, to raise, to work further in this industry. And we look forward to more such sessions in future.
Thank you. Thank you very much, Ashima. And thank you, Devang, for coordinating the entire session. And look forward to interacting with you guys more and more. My email ID is already there on the slide. Anybody wishes to reach out to me for any help, any information, most welcome.
Many of them are asking for the PPT and your contact number also.
I will send the PPT to you. My contact number is there. Let me read out. It's 9811877747. I'm repeating. It's 9811877747. You can please drop me a WhatsApp first. That will be good. And I will send the PPT to you, Devang. You can then internally circulate as per the protocol. And yes, indeed, good talking to all of you. Look forward. Thank you very much for your time.
Yeah, thank you so much, Tarun sir, to give a wonderful session to our members and participants.
Thank you. Bye. Take care.
Bye. Take care.